What in God's name is the UK doing? If you guys missed it, the British pound has dropped to an all-time low. Not only is the UK reeling from double-digit inflation, but UK's new Prime Minister Liz Truss decided this was the time she was going to channel her inner Ronald Reagan and try to institute debt-financed tax cuts during a time when the UK is suffering as the rest of the world is from historic inflation numbers. Now, of course, we're going to get into the details of all of this, but before my American cohorts say, what does this have to do with my portfolio? What does this have to do with the US markets? Well, it has a lot to do with the US markets because the US dollar is now rocketing once again. And when the US dollar rockets, well, that stunts growth stocks. Not only does that stunt growth stocks, but as you know, in a very delicate financial market, when you have these outlier moves, whether it's in bonds, whether it's in the US dollar, whether it's in the credit markets or mortgage-backed securities, anytime that you have an outlier that's forming a bubble, something is likely to break. So in this video, we will go over what is going on in the UK, why the UK government really is doing this at the moment, and why they are at odds with the Bank of England, which is the UK's central bank, similar to what the Federal Reserve is here in the United States, what that means for the stock market going forward, what that means for your portfolio. And you definitely want to stick around to the end to find out how I'm going to be playing this, because I do think that there is a play here if you didn't happen to short the British pound or short European stocks ahead of this. For those of you that are fans of this channel, you know that we shorted the market heavily here after the completion of this fractal. Ended up closing those shorts, and right now we are at major support. The shorting from here makes sense. Anyway, let's get into it. So obviously, as most of the world is experiencing at the moment, the UK is suffering from double-digit inflation. The US is near double-digit inflation. Some argue that we are already at double-digit inflation if you massage the numbers in a way that isn't manipulated, but that's neither here nor there. So the UK is suffering from 10% inflation. Now, a new prime minister was just sworn in, this fine lady right here, Liz Truss, and she decides that now is the time to institute a debt-financed tax cut, a major tax cut. Now, in order to provide these tax cuts, the government itself has to go into more debt. And if you guys are fans of this channel, you know that the reasons that we are currently reeling from double-digit inflation is because of the availability of too much free money. So the last thing that you want to do when you are in an inflationary state is to provide more liquidity. You're trying to remove liquidity from the market, which is why central banks raise rates, which is why they sell assets off of the balance sheet and they stop buying them at rates that they were doing before, because they're not trying to provide liquidity to the markets, right? So imagine if in this country, for instance, the United States, if they just announced a new round of stimulus or they just announced tax cuts that would be debt financed. That is exactly what they did in the UK. Now, Liz Truss is a fan of trickle-down economics, something that one of her predecessors, Margaret Thatcher, was a huge fan of, as well as Ronald Reagan in this country. And some argue that, hey, that policy, that type of policy is really good for boosting, especially for boosting business growth in your country. And that may very well be the case. However, when Ronald Reagan instituted his breakthrough tax cuts at the time, this was after Paul Volcker had raised the interest rates by 20% in order to fight inflation. It wasn't during the worst inflationary crisis of that time period. Now, because she's literally the new sheriff in town, a lot of critics are saying, hey, this is just a political move here. This is just a gamble that you are taking in order to appease your current voter base and boost your popularity. Also, her critics say that honestly, she has nothing to lose because she wasn't voted in. Obviously, this sounds weird to my American counterparts, but the UK did not hold a general election and she was not yet voted in. Now, they will be holding a general election no later than 2025. She could call a snap election if she wanted to, but without diving deep into British political dynamics, she has yet to win an election. So she's hoping that she can pull off a huge gamble here and that it will pay off and then, hopefully boost her popularity to win the general election and continue out a full term. In order to pay for these tax cuts, Britain would have to issue more bonds, obviously, because that's the way that governments raise money. If not through taxes, right? Which in this case, they're cutting the taxes. The only other way that governments can raise money is by issuing bonds and borrowing that money. Obviously, that money has to eventually be paid back. Now, there's a standoff between the UK government, which is making this policy, right? They are policy making, and between the Bank of England, which is their central bank, which is trying to fulfill their mandate to bring inflation down by raising rates. Just like the US central bank, they are aggressively raising rates, but the government is deciding to provide more liquidity into the economy at a time when, frankly, it is unwarranted. So because of that, the British pound tanked, and the Bank of England came out and said, we don't give a shit what the hell you guys are doing. We're going to raise rates no matter what. As long as inflation comes down, we're going to keep hiking rates. We don't care what happens to the pound. We're going to keep hiking rates until inflation comes down. And for this reason, a lot of analysts are saying, hey, if this path, if this conflicting path is maintained, then the pound for the first time ever can actually trade at parity with the US dollar, even worse, less, meaning $1 equals 1 British pound. That has never happened. As you can see, this sent the US dollar mooning, rocketing 114 right now on the US dollar index. This is the highest level that we've seen since 2002 following the dot-com crash, when the US did actually hit a recession, but was actually faring better than most of its counterparts around the world. So right now, obviously, Americans are looking at this like, hey, why the hell is the US dollar going up? You know, it costs $7 for a box of cereal. And if you were just looking at your own life here in the US, yeah, it seems dismal because inflation is basically, hitting every single sector of our life. But compared to the rest of the world, the US dollar or the United States is actually doing a lot better. So yes, we have, 8.5% inflation in this country, but that is a lot better than most other countries, especially most of the countries that the US dollar is being compared to in the US dollar index, right? So right now, we are at 114, and we might even get to this close to this 120 number that we saw back in 2002. Now, this is horrible for stocks. Why is this horrible for stocks, especially growth stocks? You might think to yourself, a strong US dollar is good for stocks. Well, not really, because more than half of the S&P 500 stocks revenue comes from outside of the United States. We are dealing with multinational corporations, especially when you talk about companies like Apple or Nike. These are companies that make their bread and butter outside of the US. And so when you have a very strong dollar, you have to take into account what those foreign earnings look like, because they eventually have to be converted into US dollars. And if US dollars are so expensive to buy in relation to these foreign currencies like the yuan or the yen, then these earnings for growth companies are muted. This is also bad because now mega cap companies have a double problem. See, yields are rising as well as the Fed is raising interest rates, and as bond sellers are aggressively selling their bonds, letting go of their bonds, which causes interest rates to rise. Now, when interest rates rise, that is bad for stocks as well, especially the 10-year Treasury note, which is the benchmark Treasury that a lot of loans, business loans, consumer loans are based off of, right? So when yields go up, it costs more for businesses and consumers alike to borrow money. So there is less money moving around in the economy. Also, future earnings are discounted a lot more at a higher rate, right? So this diminishes the value of future earnings. So when you have a dollar rising, that is bad for multinational mega cap corporations, which make a lot of their money overseas. And when the 10-year Treasury is rising, that is bad for mega cap stocks, because not only is revenue going to drop because the cost of borrowing goes higher for the consumer as well as the business, but also future earnings are discounted a lot heavier. Now, we are at a major support level here in the markets, matching not only our June lows from earlier this year, but also the consolidation area that we saw in December 2020 after that huge COVID run up, right? But we basically are near the point, we're about 6% away from losing all of our COVID gains, something that I already suspected would happen in one of our last TA Tuesday, TA Thursday videos. Shout out to TA Tuesday, TA Thursday. However, what I'm looking for here on the market is a temporary bottom. September is historically a bad month. We already discussed that in August, that September is usually a very bloody month. I did think that after the FOMC, we might get a small bounce depending on what Jerome Powell said, but he really came out guns a-blazing saying that the target peak rate for 2023 is going to be 4.6%, that employment has to go up, that he has to basically crash the housing market. He was the most hawkish that I've ever heard the Fed being. So there was no chance for a rally there. However, there could be a rally after, really like towards the election, after the election. Usually after the elections are over, we tend to see a mini rally. I'm not sure really that there are too many moving pieces because we have the CPI data, we have the third quarter GDP coming in, we obviously have the election itself, we have the FOMC meeting coming out November 2nd or November 3rd, we have the unemployment data coming out later in October. So there's really too many moving pieces for me to really gauge any sort of timing around this stuff. However, my point is that the next time we see a market rally, that is when I'm going to look to open up shorts again. And I'm specifically going to look to short the European market as well. I will also be looking to short the UK market. However, UK does have some long-term opportunities here. Like after all this is said and done, if this is a broad-based recession, a broad-based global recession, and we're talking about this in late in 2023 or mid 2023, I do think that the UK will be one of the biggest markets to rebound eventually. I'm not in any rush here, but EWU is the iShares UK ETF. So I will definitely be looking to pick some of this up. Once I think there, here's the thing. There has never been a bottom to a bear market, right? With the Fed still hiking. Okay. So when the Fed gives an indication that they are going to pause, or when the Fed gives an indication that, hey, once we hit this target rate, we're going to stop. At that point, we can start talking about an actual bottom for a bear market. We will likely see bear market rallies. We'll likely see a lot of rallies depending on how long a broad-based recession will last. However, a true bear market bottom, we will not see that while the Fed is raising rates. And I don't think that the world can recover before the US can recover, to be honest. That's just not something that happens. The US is the biggest market in the world. So I really am going to be waiting for the next bear market rally. And then I will likely start shorting the European market, the UK market, and the US market as well. But on the flip side, I'm also looking for long-term opportunities in these things. You can actually buy I'm not saying do this now, but in general, as a strategy, you can actually start dollar cost averaging into things that you want to hold for the long term while also maintaining hedges on those things at the same time simultaneously. It's like buying insurance for your investments. Anyway, if you want to learn how to do any of this stuff and you want to learn how to trade, on FOMC, we had a trader that made $54,000 on one play buying the 295 calls as soon as Jerome Powell started speaking, because of the analysis that we showed that every FOMC meeting, once Jerome Powell starts speaking, we see a market rally. Now, this was a very short-lived rally because the market tanked thereafter, but he or she locked in these $54,000 gains. So if you want access and you want to learn how to trade options, futures, you want to learn how to day trade, you want to learn how I'm hedging, you want access to our analysis, long-term portfolios, the day trading course, the options course, the Zoom calls with me, there is so much that you're getting here. Link is in the description below. We only have a few spots left for September before those run out, and you'll have to wait likely until October for those spots to open up. So book a free call, get in touch with one of our ambassadors to learn how to maximize your performance. Leave a comment down below, let me know what you think. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.